Tell me the framework of how you, an attorney, think about life insurance.
If you're losing 95% of your money to a traditional bank or other kinds of things, I think people should look to alternatives.
Life insurance has a terrible rate of return. How would you, as an attorney, respond to that?
Well, it doesn't. We're in a time where there's a lot of economic fallacies going on.
Just to be clear, if you look at history, we're right now pretty low when it comes to interest rates.
I think people need to mature a little bit and be willing to not demonize something because they don't understand it.
We also are here with Barry. I know that you guys have been working very closely together. You made a statement around life insurance being an guaranteed investment. You take that back, you double down.
People have come unglued about this. I think it's kind of funny. The bottom line is, look at your contract.
Why aren't we screaming this from the rooftops? It's because people sell it as an investment and 5% is not sexy.
From everything I can see as an attorney, it absolutely is. I might even make it worse, so maybe I should be quiet.
It's not like a 401k. It's not mutual funds. It's not stocks. It's not ETFs. The reason I said guaranteed investment is because...
Stephen, Barry, welcome to the BetterWealth Show.
Thank you, Caleb.
Thank you, Caleb.
Stephen, you're one of the co-founders of Insurance and Estates, which is one of the most popular websites out there when it comes to estate planning and life insurance. We also are here with Barry. I know that you guys have been working very closely together and co-create lots of videos, a lot of blogs. Barry, you're back on. You're only going to be with us for a few minutes, but our podcast and YouTube video just dropped. It's a little over 24 hours. It has over 2,000 views, and you've gotten a lot of comments on a statement you made about life insurance, my friend. And so I thought, instead of just having Stephen defend you, why not just have you back on? So I'm going to ask you about your take on the word guaranteed investment, and if you stand by that. And obviously you were able to read some of the comments. But before we jump into that, I'm just so grateful, Stephen, that you're here. You're a active lawyer. And you have so much knowledge when it comes to just how to help people from the legal side, but you're also a huge fan of life insurance. And I find that is very interesting. I find that life insurance it could be a hated product. It can be a misunderstood product. And so we're going to have a lot of fun with that. But I thought, Barry, since you're on and since my audience knows you, and we'll make sure to link your video down below if you've not seen our video yet on Infinite Banking 3.0, why don't you just introduce Stephen and give him his flowers before you address the guaranteed investment statement that you made on the other podcast that's making people lose their mind.
Yeah, it is, isn't it?
Make it good, Barry.
Yeah. So Steve is awesome. And what I love about Steve and his business partner at Insurance and Estates, Jason, is they are both attorneys. They understand the world of legacy planning, estate planning, but even in addition to that, they're coupling whole life insurance with this planning. So we get along very well. My company, Focus Wealth Group, their company, Insurance and Estates. Steve is dialed in because he's telling people really about the true benefits of whole life insurance from an attorney perspective, the estate planning, the creditor protection, the legacy planning. He's very good at what he does and is a wealth of knowledge and information. And I'll pump up insuranceandestates.com and even their YouTube channel. There's so much education out there for people to get. Nearly any topic someone could think about in the estate planning world or life insurance world, they've addressed it. They have a fantastic blog and ton of YouTube content that they put out there. We encourage people to look at that, to simply get educated, because as you know, education allows people to progress forward and live more abundantly in their lives.
Very beautifully done, Steve. You owe him a couple lunches next time you see him.
And he did it with a straight face too.
He did it with a straight face, and he doesn't have a script, so that's beautifully done. Question for you: I believe back in the day, did you guys, Insurance and Estates, did you guys have like a United States where you could hover over each state and it would show you what life insurance, like the benefits of life insurance, creditor protection in that state? Was that your website that did that?
Yeah, absolutely. We still have it. It's an asset protection sort of interactive map. We've got life insurance there, and we've also got some other asset protection categories in there, just to kind of show people how the protection varies from state to state. And for asset protection purposes, life insurance, it could be full cash value. There could be some caveats on it. So we want people to have the accurate picture state to state, and that's an easy way to do it. So
I love that. I have a question while you're both are on here. So I'm trying to one project that I'm trying to figure out is like how to actually put the real rate of return on life insurance. And when I say real rate of return, it's actually that's misleading because it's not the real rate of return, but it's the one when you're factoring in all the other benefits, when you're factoring in things like creditor protection or not having to buy term insurance, or if you're factoring in the taxable equivalent value. And there's certain things that are easy to factor in. Taxes, the fees that you're not having to pay, and the cost of insurance. Those are like things super easy to calculate. It's still profound. But then you get to the creditor protection. Now, in some states like California and others, the creditor protection is not something like that is that special. But in other states, and I don't want to, go jump too far ahead, but like Florida, Texas, it's amazing. How would you go about like factoring in like what's the equivalent of what you would have to pay if you weren't going to put your money into life insurance? Like are people using trust? Are they using special LLCs? Are they getting special like umbrella insurance policies? Like how would you factor in the actual like creditor protection value if you're in some of those states? And how can I articulate it in a way that's not misleading?
well, that's a huge question. When I started out, I actually started my practice in Florida in 2007, 2008. And one thing I learned real quick is that banks can be very aggressive when you're on the wrong side of the bank. I'm sure we've all talked about that quite a bit. Uh, Bank accounts are extremely vulnerable. If you get an order from a court, you can go slap a lien on a bank account really fast, and including wage garnishments and these kinds of things. So whatever money is going in there is vulnerable. So the intangible, which I think you're getting at, Caleb, is just that's an intangible value, right? The protection of safe capital is crazy. I mean, we could almost end the episode right here and just say, don't just have this, because just for that reason alone, you've got safe capital tucked in a contract inside of a contract that has state law protection surrounding it. And so when you have safe capital or capital that you think is safe, right, in a bank account, it's not. It's very vulnerable. So now I want to answer your question. How do you quantify that? I mean, there's a huge peace of mind component to that, right? You just know that you're going to be able to negotiate with creditors. So whenever I would get contacted about asset protection, usually it's when somebody's already in trouble. So right there, you've got a problem. There's laws around that called fraudulent transfer and things like that. So if somebody contacts you because they know that their cash is vulnerable and there's nothing they can do at that point because they already have an active lawsuit in place, what's the value of that?
Right.
I mean, you almost can't quantify. I mean, it's that peace of mind and that negotiating power. So the reason that you would do an asset protection strategy, whether it be a trust, LLC, whatever it is, to try to get asset protection around your safe capital. Ideally, you want all your capital to be safe, right?
Right.
But if you were going to set up all those entities in advance, you might pay tens of thousands of dollars to set them all up. You might even go so far as to do an offshore trust, something like that, if you have a lot of wealth. So it's hard to quantify how valuable that actually is. What you did is you just created a situation where you have negotiating power with your creditors.
Yeah. And that was really my question. Obviously, every one of us on this call is a fan of life insurance, but if someone wasn't, but they still valued creditor protection, I would want to play devil's advocate with them and say, okay, what would you have to pay to get maybe the same benefits that you're getting by having your money in cash value? And you're saying that it could cost up to tens of thousands of dollars. Some people could get more advanced. What would be like the cheapest way to like get creditor protection on some of your assets that you wanted liquidity and access to? My producer just told me something wild. Only 6% of you who have subscribed to our channel have enabled notifications for our videos. That means 94% of you watching right now won't get told by YouTube when we upload a new video. So whether you're brand new or one of our longtime subscribers, if any of our 1,000+ videos have helped you think differently or brought you value in any way, I'd love for you to hit that bell and turn on all notifications. We've got some incredible guests and conversations planned for 2026, and I don't want you to miss them. Thank you so much for supporting this channel, and I'm excited to keep growing with you.
So asset protection comes from contracts, and it comes from state laws that enforce those contracts. So, and by the way, life insurance is a contract. It's also a trust. We know that, but we know it's a contract. We don't always know it's a trust in a way. Um, so you have these multiple things coming together. If you wanted to set something up equivalent to life insurance and have it be asset protected, you'd need to do a contract of some kind. So you might do an LLC with an operating agreement. It's got to have asset protection in it. It would have to be deemed to be a valid LLC. So any
Yeah.
asset protection can be challenged, right? So if you put
Most
something together, it's kind of
LLCs
hokey
wouldn't
and then
pass
put a bunch of money in it.
the valid test if they were really challenged.
Right. So if you're the creditor, what are you going to do? I'm suing Caleb for some reason, and he's got $100,000 in an LLC. What am I going to do? I'm going to say, well, this is not a real business. I'm going to try to pick that LLC apart best I can. I'm going to demand the papers. I'm going to say, where are all the partners? Did they, were they running an active business out of it? And attorneys will sell these, and they'll say, well, if we put the money in here, we're pretty solid. But the test is whether you can attack it. So
Yeah.
you're going to have a hard time attacking something like life insurance. Trusts can be solid, and depending on what state they're formed, they can be effective for asset protection as well. But when you talk about trusts, so an LLC might be $3, $4, $5 to $10,000. A trust is probably, if you're going to do an asset protection trust, it's probably going to start at least 5,000, probably more like 10, and go up from there based on
Okay.
what you're doing with it.
We'll have to talk maybe as maybe a part two. I am really curious to see how we could ethically factor this in, and I think that's a whole different project. But the reason I care so deeply about this is the more you educate people on, like we just talked for 5 minutes on asset protection. I've never seen someone actually factor that in to the IRR, or the equivalent rate of return of life insurance. A lot of people mention it, but I find that it's like, okay, you mention it, creditor protection, great, but it's sometimes hard. Like sometimes I really like to see like option A versus option B. And is it true? I think Barry Dyke wrote about this in Pirates of Manhattan, where the Enron executives still got the benefits of their life insurance and annuities in the state of Texas. They committed fraud, but the states was so strong that they still got the benefits of insurance, even though they scam people. Which is, you can feel bad about that, but you also can feel really good about that, to say, like, if they're getting the benefits of insurance, how much more would that be for people that aren't necessarily scamming people for a living?
Yeah.
And
You're gonna
Caleb,
get
think
me on a
about this
soapbox,
too.
Caleb. Oh, go ahead, Bert.
Just from a simplistic perspective, let's say you've got a person that has $1 million or $10 million in cash in their bank, compared to that same million or 10 million in a cash value life insurance policy. And depending on the state, right, if they've got great creditor protection in their state, clearly they're going to want that money in the life insurance policy if they have creditors coming after them, if they're filing bankruptcy. So how do you quantify that? Maybe you do a person A, person B, person C to say, here's some scenarios, here's some case studies. But all day long, the person who has the creditor issues or the bankruptcy issues would much prefer the cash value in a life insurance policy.
Yeah.
Yeah. Don't get me on a soapbox, Caleb. People forget that we're a nation of laws. It doesn't matter if you really don't like a bad person, you think they're terrible, but all the state laws protect all their stuff. We're a nation of laws. If you have tyrant, or as you should say, like tyrannical government, that can come in and just trash all the laws in order to, institute justice, then you really don't have a very coherent society, right? So that's why these contracts, and this is why, by the way, this goes to the whole core philosophy of, what we do. And I'm sure you feel the same. We love contracts. If you think about wealth by contract, you're in an entirely different ballgame. And we can talk a lot about that. I know we're going to touch on IULs, which, in my opinion, is a degraded contract from what you have with a high cash value whole life contract. So
Cool.
we could talk about why that is.
Yeah.
Same thing,
I
same thing with market-based accounts. You don't really have, you're not, contracts allocate risk between the parties, right?
yeah,
So if you have, I mean, how much risk do you want?
that's
The
right. That's
flashier
so good.
the
Steve,
flashier the product, the more risk you have. I can guarantee you, how if the product is flashier, you've got more risk.
Steve, how
Eh,
did it take us 5+ years to get connected? I don't understand this. I'm gonna have a ton of fun. I want to talk about that. I also want to double tap on the trust because you say a lot of people we talk about life insurance as a contract. I can't articulate well life insurance being a trust, even though I agree with you. I could repeat the talking points, but I want you to even educate me on how life insurance can be a trust. Before that, though, Barry, I don't want to I want to hold you hostage here from a standpoint of us just talking. When I had you back on, or when I had you on for the first time, we talked about infinite banking 3.0, and you talked about kind of like level one, level two, level three, and you made a statement around life insurance being an guaranteed investment. And I remember, I remember when we were talking, I was like, oh boy, like anyone that knows my language, I like harp. Life insurance is not an investment. It's not an investment. It's actually like it because there's no risk tied to it and all those things. And so I know language matters. We have an attorney on here. I know that language matters, but I also want to give you the floor. You saw some of the comments. I think a lot of people very much agree with your talking points, but I think some of the people that disagree are the loudest in the comments. And so I just want to give you the floor to be able to address that. You take that back, you double down. You have the floor, my friend.
Yeah, thank you. And I think what Steve just said is a great segue because he's talking about contracts. Is life insurance an investment? No. It's not like a 401k. It's not mutual funds. It's not stocks. It's not ETFs. The reason I said guaranteed investment is because if you look at any whole life illustration or policy that I have with clients, there's several guaranteed phrases. Number one is guaranteed cash value. There's a contractual guarantee of cash value growth and cash value acceleration, right? As long as you're funding the premium correctly and meeting that requirement. There's also a guaranteed death benefit. There's a guaranteed crediting rate. So I like the word guaranteed, Caleb, because the life insurance companies are using the word guaranteed. But to consider it an investment like I described with mutual funds or ETFs or whatever the case might be, it is different. But when I say guaranteed investment, I want people to really resonate with the word guaranteed. You have, as Steve mentioned, a contractual guarantee with a mutual insurance company that's been in business for 120 years, 150 years, 175 plus years. You are guaranteed to make money in that contract every year. So I say, hey, it's a guaranteed investment. It's a guaranteed savings, whatever you want to call it. You're getting guarantees within that contract.
So when I look up the definition of an investment, it's an investment is an intentional allocation of capital into an asset with the expectation of future return. So everything's good so far.
Yeah.
That is not guaranteed. So literally the definition of an investment is not guaranteed. So is there, Steve, is there another word that we can use that's not investment that doesn't trigger? I think the only reason people are triggered is the word actual investment.
Who's
Oh, for
triggered?
sure.
First of all, who's triggered and who made that? Who created the definition? Those are my two questions.
Yeah,
But
that's a good.
I mean, investment managers are triggered because they don't like anyone getting in their playground. Maybe but I might even make it worse. So maybe I should be quiet.
Yeah.
I think by definition, if an investment is deemed to have some speculative risk attached to it, then sure, then I guess, a contract that provides a guaranteed return wouldn't pass that definition. And therefore, people are going to say, don't define it that way. Right.
Right.
So,
And
okay, well,
yeah,
we can
and
see then if that's your definition, anybody listening, if you made the comment and you're really mad and you're ready to pounce once again, then fine. We can see that if that's your definition, that an investment has to have some risk attached to it.
Isn't it interesting? And that we're just going down like when you take investment tests and Series 64, 5 and all these things, like they almost like you're actually just taking a regulation test of like, this is what you can't say, this is what you can say, and this is what, and it's just like they're
Yep.
almost like creating it is actually we could get my I could get myself in trouble now because you're almost creating a bunch of yes men and women to just go along, and it's like, hey, if you don't follow the rules, we're going to take your license away. We're going to make your FINRA's going to, and it's like, oh, you wonder why certain incentives, why certain things are deemed that way.
Yeah.
That's an interesting point. Barry, you're going to say something?
Well, yeah, people have come unglued about this. I think it's kind of funny. And the bottom line is look at your contract, look at the illustration, look at the word guaranteed all over those contracts. So if you want guaranteed money in your portfolio, if you want access to cash and then tax for use of that money, and then we're talking about estate planning and legacy planning and creditor protection with Steve. As I said before on the prior podcast, in my 25 years of doing this, Caleb, I've never seen anything better that
Yeah,
fits all in that box of high cash value whole
yeah.
life insurance.
I
And it is guaranteed.
Yeah, here's just a thought, and we'll see what the comment section thinks about this. Is what if we call it a guaranteed asset? Now,
There
asset
you
might have a
go. Yeah,
less
great.
it might have a less ziz than an investment, but the definition of an asset is anything you own or control that has economic value that can be used to produce, preserve, or transfer value over time.
I
So
love it.
Well,
it's a guaranteed asset, and there's not a lot of assets out there that you can actually say is guaranteed. A lot of people say real estate. Real estate's not guaranteed. There's most assets in general might be really, really solid, but aren't really guaranteed. Life insurance is one of the few assets out there that you're totally right has rock solid guarantees tied to it, which by definition makes the asset it inherently should be factored in also to the equation. If something's guaranteed and something's not, if I'm paying you 5% on a guaranteed basis and a non-guaranteed basis, you're by definition going to take the guaranteed. So that the non-guaranteed asset needs to earn more just to keep up with the guaranteed asset, just if you factor in risk, which is a whole nother thing that we could talk through. But that's another thing that I'm trying to figure out how to quantify. Steve, it looks like you wanted to say something.
well, I like what I mean, I think we all agree. You've got the and asset. We talk about the ultimate asset quite a bit. People get a little mad when we use the word ultimate too.
Yeah.
Um, but asset is accurate, right? A contract is an asset.
Yeah.
Real estate is an asset, and they're okay with calling it an investment as well. I guess because you could lose money on it, right? Since we're adhering to the same standard, if you can lose money, it's an investment. Okay,
Yeah.
so the wealthy buy assets, and everybody knows that a contract can be an asset. It is an asset, right? You're contracting for mutual benefit and to allocate risk. So we talk about it in different ways. Interesting discussion around investment.
Yeah, it is
Yep.
interesting. Barry, is there anything you want to say before you hop off?
No, just for people listening, don't blow up the comments, right?
No, we
We're,
like it.
we're
This is engagement. We blow
yeah,
up
this
the comment.
engagement.
Comment
Blow it
on
up.
like
I mean,
how white
it's
Barry's teeth are. You're a good
yeah.
looking guy, Barry. I appreciate that. But no, we want to hear from you. Just keep it PG and
That's right.
also it's someone once told me the critic statue, and I was like, what? And he's like, no city ever has a statue of the critic. It will never exist because it's easy to criticize and it's easy to be if you're getting criticized, that means you're doing something. And I always remind myself as I read the comments section because it's easy to remain humble. Like that's the way that's the way I stay humble is I just read the comments every day and I'm like, okay, uh, there's a lot of improvement to happen.
Yeah. And ultimately, before I wrap up and take off, is we want people to have guarantees in their portfolio, just like you do, right? So guarantees provide someone certainty, predictability, and ultimately peace of mind because the traditional planning, whatever that might look like market based, there's a lot of unknowns. We're here to say, look, why not have some guarantees in your portfolio so you can have more peace of
Yeah,
mind?
appreciate that, Barry.
Yeah.
We'll Appreciate that. We'll have your link to your book in the description, and you're always welcome on, and we'll have to have you back on to talk more about all the things and more. All right.
Awesome. Thank you, Caleb. Thank you,
Thank you,
Steve.
Barry.
See you, Bear. Yep.
All right, so Steve, I'm really interested in this idea of trust, and I would love, in your own words, we talk about life insurance as a contract. It's a unilateral contract between an individual and an insurance company. Not all contracts are created equal. Not all promises are created equal, and that's why it's important
Right.
to worry if an insurance company started in 2026 and was like, "Hey, trust us," that contract's going to hit different than the one that's been around for 150 years, just from a credibility standpoint. So I think
Yeah.
we got that. I don't know if there's anything you want to mention on the contract side, but I want to better understand the benefits to me, the consumer, the benefits to me, the person that is interested in life insurance, why life insurance is also considered a trust.
And this is something that dawned on me more recently as we talk about planning a lot. And somebody mentioned it to me, and it really resonated. And you've even heard, bank and trust. I think you come from the banking background, if I'm not
Yeah.
mistaken, right,
Yes.
Caleb? So there's trusts all over the place, but a life insurance policy functions like a trust because you're putting money into it. There's somebody managing that money for the benefit of the owner initially, and then the beneficiaries, whoever they are, later. So from that standpoint, you have almost an exact uh, parallel to what a trust looks like. You've got your lifetime benefits, and then you've got your death benefit. That's in a properly designed policy is accruing throughout the lifetime of the person. And so, and in a sense, it's not, the terminology is not identical, but the life insurance company is really the custodian or trustee of the asset during the lifetime of the owner. And you can have that, right? If you set up a trust, Caleb, you could set up a trust, you could set up an independent trustee of that trust. You may serve as the trustee during your lifetime. You might set up somebody independently to manage assets. You also may hire people to manage assets. You might hire a financial manager, whatever. And that trust is going to be in existence during your lifetime. Then upon your death, and that goes to whoever you've designated. So from that standpoint, the life insurance policy contract functions pretty close to a trust. It, now, there's different kinds of trusts too. In a way, this is like an irrevocable trust from the standpoint it has asset protection, which is what we just talked about. If you set up a living trust, you may have one to protect your family or whatever. That trust is more flexible, so it has different characteristics than life insurance does, I think. Although you can cancel life insurance and things like that too. So that's how I look at it. I just think it's another, when you consider your long-term legacy planning, it functions alongside a trust and can complement a trust. It can also be aimed, the death benefit can also be aimed at a trust. I know you guys have talked about that over here. I think I saw that episode actually, or one of them. And it goes hand in hand with legacy planning. If you want to really create continuity with your policy, with your asset-based infinite banking plan, whatever you want to say, then you also can direct the proceeds, the death benefit proceeds, to a trust, and you can even do dynasty trust planning depending on your state. So you've got this whole continuity thing,
Yeah.
which is a wealth transfer
It
strategy at the end of
it's
the day.
interesting because you get some of the benefits of an irrevocable trust, but you also get the benefits of non-revocable trust when it comes to you know accessing your money. And so life insurance is very unique in that aspect. And yeah, there's a lot more questions I could ask you about that, but due to time, we're going to continue. One of my favorite questions to just to ask someone like you is, tell me your aha moment on like how you learned about life insurance, because you're obviously going down the attorney route. So it's not like you're like, hey, I'm going to be an attorney to be able to like really understand life insurance. So I'm assuming through your journey, you learned about this asset, and I want to know like where the light bulb moment was for you.
Yeah.
And then my next question after that is going to be like, since learning, what are like, tell me the framework of how you, an attorney, think about life insurance, and if like you could download what you know into everyone's mind who wants to learn a better way, what would you tell them? So that's like 10 questions in one. But I first want to know how you discovered life
Mhm.
insurance.
Yeah, absolutely. I like telling this story. I've got a book, The Self Banking Blueprint, which I wrote to kind of share my experience in coming to understand this asset. And it started with my uncle. Actually, my uncle was a really accomplished at Northwestern Mutual, which is one of the big names in the biz. Maybe not our favorite one at this point, but he was very successful at that. And I was probably, I don't know exactly how old you are, Caleb, but I was probably about your age and a little younger maybe. And he took me into his office and showed me an illustration and was kind of giving me the overview of high cash value whole life. This was before, it was just as I started working. I was actually more in the real estate arena, but he gave me the picture of it. And at the time, I thought it was interesting. I thought that the idea that you could put money into something and see it grow, guaranteed over time, was intriguing to me. But I was also pretty young, and I think I have a heart for helping younger people at this point, because I feel like, look, this was sort of a gift. I didn't even grab onto it right away. It was like, if you intentionally do this with your money, it's going to grow to this. If you just commit to it over time as part of your wealth building, then this will serve you down the road, right? So that was one seed planted, but it took me a while. It took me some life experience, another 10 years where I was going to different things. I probably ended up in estate planning because of some seeds that my uncle planted. I liked. It's not the thing that when you go to law school, that you think I'm going to be a trust attorney or an estate attorney. You're probably thinking more about courtroom drama and things like
That's
that.
right.
And
There's
that
no
was an
TV
initial,
shows on those, yeah, on that type of attorney.
yeah, that was an initial interest to me. I was interested in the thought process and the debate. And there, obviously, I have some of that. I'm getting kind of charged about some of these comments, but the point of that is that I wanted to get into something that was a little more. I could help people find peace rather than just making war, which is what a lot of lawyers end up doing. A lot of is a lot of controversy in their practice. So having tried some different things, I started doing the trust planning, started talking to a lot of families, sitting with people more toward the end of their life, seeing a lot of different financial portfolios, and a lot of them were heavy IRA, 401k based. It was common to see million plus 401ks. And so I saw a lot of that, and I saw the complexity of it. So I started to think that it wasn't what it was cracked up to be. And I also perceived that it wasn't what it was cracked up to be for me either. It wasn't having a 401k and just putting money into it seemed like kind of a tough proposition for lifelong wealth building. And I saw a lot of other people. Most of the people that I saw built wealth in their businesses. They built wealth through investing in real estate, or if it was stocks and things, it was because they were really good at trading. So I noticed that people had skills, they put it to work, and they built wealth. But it wasn't because most of the time, if they did follow a system, it's because they had a job for 20, 25 years, and they did accrue some money in those 401ks. But so long story short, I started to see a few people that had high cash value policies. I remember seeing one that was I believe it was a Guardian policy. And this thing, look, I mean, I'm thinking this is great what these people were able to do over this time. And it was shared with me that this is our favorite asset at this
Wow.
point. This is our, and I was like, well, I can see why. I mean, it had a lot of cash in it. It was liquid. It could do a lot of things, had a nice death benefit. They're feeling really, I mean, I was seeing all the peace as an estate planner that they could have. And so I saw that. And then I had at one point a colleague who was doing high cash value policies kind of pulled me aside. And I ended up doing a couple of events with him. And he started coaching me on how do you use this asset to create a better situation in your finances. So he started talking to me about using it as your personal bank, this kind of idea. And at first I was skeptical. I thought, okay, well, it sounds kind of like maybe a sales pitch or something. But the more I looked at it, more I learned about what the companies can do with policies as opposed to your typical base whole life policy that you're able to store cash in these things. It resonated from a financial standpoint to me that you could add cash with the protection around it And, you're kind of comparing it to 401k of the code, right? 401k of the code is put in place to help people defer taxes and to create a mechanism to grow money tax deferred, which people seem to be, everybody's okay with it. It's great, except we talk a lot about how it's very, very inefficient. At the end of the day, when you try to pass one of those, it was complicated. I would always hope I wouldn't get one of those to
Yeah,
pass
how
it.
do you pass a 401k?
Well, it's got beneficiaries on it, right? And so hopefully the beneficiaries are right. And but the laws change around those. So you've heard of the Secure Act, I'm sure. Well, the Secure Act now requires a 10-year payout. So what would happen is that when that change happened, then they started putting a lot of provisions in trust to try to create stretch provisions where they didn't really exist. So the one thing about before that happened was if you give all your money from a 401k to one of your kids or something, and they're young, they could stretch that out for their measuring life in the same way that if it was their 401k, right? Because you could do that with your 401k. I can do it. Somewhere along the line, our government officials decided that instead of allowing that, they're going to make adult children, anybody other than a spouse, pay it out within 10 years. So you got to take, let's say you got $1 million IRA or 401k and one of the kids gets it. He's got to take a lot out. He's got to draw that down over 10 years. So we wrote a book about this. My partner, Jason, with Insurance and Estates, is a pretty prolific writer. We just wrote a book about, call it Kingdom Money. And has some principles in there. And so what it is that this is an asset. If you really look at it, like a lot of these conventional assets are designed to be utilized and exhausted within your lifetime. They're not so much a legacy promotion where they're going to go from one generation to the next and fuel continual wealth building. Because what happens, right? Even when you start taking from a 401k, you're getting taxed. All of a sudden you're getting taxed, right? Taxes are taking out. And then if you try to give that to somebody, that's going to be subject to taxes and with a 10-year payout. So what happens is it all negates the wealth cycle that you want to accomplish if you really do care about leaving an inheritance or whatever for your kids. And there's a lot of discussion in our industry around that. So
Yeah, there's so much. So that was like the eye-opening to be like, oh wow, like this is 10 times better than a 401k if we had to pass this on from an estate planning standpoint. You meet a couple who their guardian policy at the time is like their favorite asset, which makes me happy because I always like want to like face plant when people are like, "Oh, do I have to pay this ongoing? Like when can I stop?" And I'm like, "Okay, number one, it's a lot more flexible than you think. So you're not going to get stuck at 65 having to pay your life insurance if that's what you're asking. But it's like
right.
there's something that you clearly don't understand if you're asking that question. It's like I, that's where I feel like I just let someone down. I'm like, yes, it's like almost like, yeah, you don't have to pay, but you want to. And don't look at this like a bill. Don't look at this like you're funding your investment account. It should be one of those things where you would want, as long as you have cash flow and you had the ability to fund, why wouldn't you? And that for me is like, I think if someone gets to that level, they now understand what you're saying around like life insurance actually being someone's favorite asset because it can enrich their life today, but there is something spiritual about knowing that you're going to have your family and your next generation taken care of, or a charity or a cause that you just know, like, hey, like my life, like the life that I've built, has value tied to it. And I'll use myself as an example. It's like I'm hoping to make a lot of money in my life, hopefully adding tons of value, building lots of businesses. But if I don't today, we have many millions of dollars of death benefit that gets paid, and obviously that I'm hoping to live. I'm like knocking on the wooden desk I have right here. But like
Right.
even if I didn't, I'm grateful for the plan that I'm set up. And if I do, I will have lots of cash value to continue to be able to make moves. So it's almost like from a financial standpoint, I'm increasing likelihood of legacy efficiency by having life insurance versus any other asset, including the business that I have, because the business is great, but it's not gonna be as easy to be able to manage and grow versus life insurance. I know I said a lot there.
Yep.
Since you got like the epiphany, then you're like diving in, and when did insurance and estates, the website idea come out? Like, you guys are known for being like one of the nerds out there, and I say that respectfully when it comes
Yeah.
to understanding how to integrate life insurance. Since then, like, what are some of the other things that you learned since having the blog that you're just like, man, if people could understand this, there'd be a line outside the door?
Right. Wow, that's a really good question. I think that when I talk to young people, I had a question on a podcast a while ago, and the guy was younger. Like he might have been younger than you, Caleb. Once again, and he asked me, "Well, what would you say?" And I would say, "Look, as a young guy, and I didn't feel like there was enough of this. You know, be very intentional about what you do. And one way to do that, of course, is to have a contract that's a superior basis to build wealth upon. So the light bulb there is just there's an ideology around this, and that's something that has really been sort of stirring in me over the last couple of years. It took me when I was introduced to this and started thinking about it. It probably took another 5 years before I connected with Jason, my partner there at Insurance and Estates, who's also coming from an estate planning background. Set up the website. Our goal has been to bring this asset of high cash value, primarily whole life insurance, to the mainstream. And that's why we set out to provide the kind of educational content that we do to try to clarify it. So there's a lot of misnomers around it. A lot of the strategies are sort of hushed by, behind closed doors, agents and insurance people talking about them, split dollar, whatever, just the different things. And nobody really knows, it's hard for people to understand what you can do with this asset. So we try to educate on those things. We try to educate the mainstream and the wealthy. The wealthy have some idea of this, but you'd be surprised. It's a this is an area that has a lot of it shouldn't, but it has a lot of interesting mystique around it. People, you really need to be able to forge in and talk about the volume of your money, and if you're losing 95% of your money to a traditional bank or other kinds of things, how productive is that? You talk about how much money somebody can make over their lifetime, these kinds of questions. So, but if you're very intentional as a young person, then you can get on the right side of that,
Yeah.
and you could have momentum, the wind at your back, so to speak, through your lifetime. Not to mention, Caleb, just the peace of mind you're talking about. What's that worth? I mean, talk about quantifying things. Like, what's it worth to think, well, if something did happen to me, then my kids and wife would be well taken care of. Uh, I just heard about a guy, 50s, a pastor actually dying of a heart attack after his recent sermon that he preached. I was kind of shocked. He looked like a pretty young guy. There was a picture of him, and these are always shared in the life insurance world, right?
Yeah.
Because they're the way to kind of get attention. But it's not the only way because, and we used to do the same thing in estate planning. So there's so much overlap. If I were to say, you got to have a trust, Caleb, and stuff like that, a lot of people don't want to think about that either. So I was used to that, getting
Yeah.
into this arena,
You're
and
used to representing something that not everyone wanted or thought they
or
wanted.
not everyone would want to admit it and
Yeah.
or think about it. A lot of times, wives are dragging husbands in to get trust done, that
What
kind of thing.
if someone trusted you and said, "Steve, like, why would I put my money into life insurance?" What would you say to them? Like, how would you explain what benefit they would have to putting money into life insurance?
Yeah, I would say that I can speak from my own experience and say that it's been having this backing has been a blessing to me, both as an entrepreneur, but also as a husband and dad, because I don't really ever worry about if something, were to happen, and I don't have to just shove it to the back of my mind, which I think people do, So that there is a big one. Um, I also think that we're in a time where there's a lot of economic fallacies going on. I often equate it to the health and wellness arena, um, Caleb, as well, because I think people are understanding. I'm contrarian on both fronts. you're told to do a bunch of things, not very good for you, but this is the way that you should do it. It's the same thing financially. There's a lot of things that are not really very helpful. And so I think people should look to alternatives. I think people should look to things that people are really enthused about. Like we are when we talk about this, or we have almost 300 Trustpilot reviews on our website. So Barry gets a fair number of those. And that stuff tells the tale. I mean, you don't have to always think that the quote sales guy is just trying to twist your arm to do things. It's about what is working, right?
When
And I
when
would I
people
would
are
be every
coming
bit as avid in
when
other
people
arenas.
are coming to you for life insurance, is it mostly because of the legacy benefit? Is it the infinite banking with the legacy backstop? What is in your opinion, like, what are the people most attracted to when they want to learn more about life insurance?
Yeah, people are they in my view, they're passionate about the alternative to be able to have something that's theirs, that they actually know they're confident is going to serve them. They get excited about infinite banking for that reason. They want to learn more. We have a lot of I think people want financial hope. They want to know that they're going to have something. I really think that the culture of and this is something that raised me, the culture of ROR obsession and slicing and dicing every financial decision on, well, what's my return? What I don't get it. You can only get that return. How do I say this? It's are we trying to promote a culture of peace for
Yeah,
people and methodical building, like building a house,
yeah,
right? It one brick at a time. If you're building a brick house, it's not an easy thing, especially at the beginning. You got the whole
yeah,
house to finish. But if you keep building it and you keep
yeah.
methodically paying attention, then you can
You
eventually
don't
have
talk like
peace.
a average estate planning attorney. I like it sounds like you very much like to read and think and so I appreciated that about you. Um, when we talk about IUL, you talked about it potentially being an inferior contract. I don't want to put words in your mouth. W it's always amazes me when I had 2 conversations in the last week of people who didn't necessarily knew who I was, like, they didn't know, like, they knew I was in the business, and so they're talking to me, and they're almost assuming that I know, because 'cause I'm young, "Hey, let me explain to you how this thing works," and it was actually pretty interesting to, like, take a step back because a lot of people have their guard up with if they know who I am, but they didn't know who and they're just, like, selling life in index universal life insurance to the moon, and they're, like, bad mouthing whole life, and they're like, "You" because I told them that I, sold like, I'm a sold whole life kinda deal, and they were just like, "Yeah, you didn't know this, did you? Because if you did, you'd be" like, they didn't try to be demeaning, but I was just like, "Yeah, that's an interesting point."
Yeah.
And, I was trying to be polite and listen, and so it's just interesting to me, like, I of course, if you don't if you're looking at, like, what's easier to sell, IUL across the board it's like flexibility, upside, there's so many other talking points to IUL that it's like
Yeah.
makes it amazing, and I don't want people to be like in the like, yeah, I would like to make more money. I would love to talk about those things. I also like peace, sleeping at night. Is life insurance an investment? No. Like so like there's other philosophical aspects of like why I gravitate to whole life, and when whole life structured properly, you get a lot of flexibility as well. So it's like there's
Yeah.
that aspect from an attorney standpoint, talk about how you look at trusts and contracts and the
Yeah.
difference between a IUL contract or a universal life contract in general versus a whole life because they're both called permanent life insurance.
Yes.
But I feel like we're demeaning permanent sometimes when we're giving permanent to both of those chassis.
Yeah. I'm really glad you circled back to this because I think it's very important. The the contract idea, right, is how much risk does each party have? I mean, that's consideration. So you pay for a contract and then you have a value for value. Otherwise, it wouldn't be a contract, right? And so you're paying the insurance company for something and they're giving you something in return. And so when I mentioned IULs being an inferior contract, it from everything I can see as an attorney, it absolutely is. I mean, you what they're doing is And it seems, that everything, people get mad at salespeople. Everything is selling, first of all. Everybody's selling something. They're, now, hopefully they believe in it. Hopefully they really have looked at it and really think that this is a solid, healthy, good thing that they're selling. And for me, I wouldn't be able to tolerate doing anything that I felt was not helpful to people and not solid. So when you look at an IUL contract, you're looking at the possibility of gains, and they do a cap on that. Of course, they don't want to get too much in the weeds, so they cap it. And then with the costs, those costs aren't fixed. So what they did is they took a chassis of a good, solid whole life contract to me, and they said, "Oh, well, how can we, maybe swing this a little bit, add a few more things that consumers might like, but then remove a few things that frankly are, better for us." And so I look at it, the we've seen a lot with IULs over the years. And one of the ways is how they're marketed. Now, regulators have tried to rein that in, right? So they kind of say, hey, you can't use a brand new index and say that you're going to get 15% or something. I mean, it should be obvious, right? So you have that, but you also have, under the guise of flexibility, first of all, I don't think they are any more flexible than a whole life contract that's properly designed. If you don't fund them and you're on the wrong side of the markets,
Yeah.
then they'll start to cannibalize themselves. So,
which doesn't happen in a whole life. Yeah.
right, it really can't happen because of the fixed costs. So what did you do with a whole life contract? You locked in your costs. You have a guaranteed return. I mean, this is as good as it gets, really. And then you've got your dividends, which people are like, well, don't say that. You're not going to get, the reality of it is dividends are a pretty stable expectation. People don't say, go ahead and buy this stock. It's been paying dividends for, 50 years, but you might not get them. I mean, you could if you were going to apply the same standard across the board, right?
Yeah.
So I would say the risk factor on IUL with the costs, with the, the way they're illustrated, and you can do them right. We have a guy that does them in-house. Even he has expressed some apprehension to keep doing them, to tell you the truth, which was interesting. So even people that have been in the business sometimes say, I don't know if I want to keep.
Well, and I believe the consumer should make the best decision for them and see the pros and cons. I just think it's really important for them to understand, if you're going to be pitched something, to see the whole story and not just see, like most people selling IUL or whole life, they're only given one option. And I think you should be able to see the pros and cons. But I think you also need to factor in what is risk. And it's weird to me that in permanent life insurance and IUL is sold like a non-risk thing, but it really is a little misleading in some areas. And you got to factor in, like, okay, what in this contract, what outs does it give the other party? And let's play this out. In whole life, what outs does it give the other party? The only outs that it gives is if you don't keep your end of the bargain. And let's just say, like, the policy, you stop paying it, you take 100, all the loan to value is at 0, and then it literally, like, okay, then the outs are, policy cancels and the insurance company doesn't have to pay the death benefit. In an IUL, there's a lot more outs that could happen there. And I think it's like, and everyone will say, well, that will never happen and all that. And sure, like I hopefully that will never happen. But from a contract standpoint, those need to be factored into the pros and cons. And you can't just say IULs are better because the projection's better. It's like, well, there's potential baggage that comes with a potential greater projection.
Yeah, well said. And it already has happened. I mean, we've seen IULs blow up in the past for different factors, different reasons.
And they're always changing them, and they're like, well, it won't happen this time. Well, and it's like, man, you guys have a lot more faith than Steve and I,
Right. We'll be good this time.
Just to be clear, and what you're saying is, and we do as well, like there have been people that have come to us that have chosen an IUL. It sounds like the same thing, especially for estate planning. So IULs are not inherently evil or bad. They're just, they're missold And a lot of people that get licenses, that get in these network marketing companies and all, a lot of them gravitate towards these type of products because they're easier to sell. But I just want to be really clear that index universal life is not inherently bad. You just have to understand like all the moving pieces, and not like understand, like factor in some of the risk into that, and it becomes way more equal, I think,
Right.
if you really look at it on that scale.
Right. It's a contract. And that's why I like to use the contractual language, Caleb, because I think your caution is correct. If somebody wants to have money inside of a life insurance contract where they can try to take advantage of market gains, then that's valid to do that. You just have to recognize that if you have a bunch of down years, you could be your costs could be eating into your contract.
Yeah.
So that's
And the
it's
company could change cap rates, interest rates could change. Like there could be lots of things that could affect your current projection. So we're gonna move on, and
yeah.
I have a couple questions to ask you as an attorney that I've asked other guests, and I'm just gonna be curious to hear how you answer this. So a common phrase that people will say when it comes to life insurance is it's too expensive, and that you should buy term and invest the difference. What is your response to the person that says buy term, invest the difference is what you should do when it comes to protecting your family and also making sure that you have the best strategy going forward?
Yeah, I mean, and this is a very rich topic for us. We've done some videos on it and stuff, but the reality is that first of all, if you buy term, then it's going to expire at some point. It's going to get more expensive as you get older. So from an estate planning standpoint, if someone's real young and they want to do it for a while because they're putting all their money into something else, and maybe then they circle back when they're still pretty young, then maybe it's not so bad. I think there's tons of misnomers. Like we could talk probably for a whole hour, Caleb, on this, but like, what's the idea of investing the difference? What, where are you going to invest it? Are you going to put it in market based accounts? That kind of question. If you do, then it's not on par with what you'd be doing if you put it all inside a high cash value whole life policy. You got a different bucket that you're putting it in. Even if you put it into a 401k, you've still, then you've got a different bucket. You got a tax deferred bucket. I think you have the sequence of returns, risks. You have more risks. So if you number one, backing up, term is a bad idea from the standpoint that as you get older, it's going to terminate at some point in your most vulnerable years. I told you that I've sat with people in their older years. My dad had a term policy for many years. He paid on it for like 20 years, and then it expired at one point when he was older. It wasn't feasible for him to go get. He's in his 80s now. It wasn't feasible for him to go get another term policy at that point. You just kind of wave it off, and so then you get into this question of self-funding. Are you going to have enough assets that are liquid to help to make sure your estate and everybody's taken care of? So that those are all the questions that arise. You've got, is term a good idea? Where would you invest it? How do you again quantify
Yeah.
the rest, the peace of mind that you get and everything else with?
I've had so I interviewed a couple people that haven't released on the channel yet, but like Dr. Wade Fowle recently. We've talked to Curtis Cloak. We talked to Dan Fleischshaw, we all are like reviewing life insurance and investments can give you like better income, and in almost every case they give you a greater legacy when
Mm.
when you mix those two together versus one or the other. And I understand like the whole buy term can look pretty great, and you're like, oh, what are you talking about? But if someone cared about legacy, like if that was something that they actually cared about, buy term invest difference becomes less attractive because now you're tying up some of those assets so like life insurance automatically becomes more attractive, permanent life insurance, because it frees up those other assets. Now, I also know that there's a lot of people that we talk that are like, I don't want to give my kids anything. And that's a whole different conversation that probably for another time. But if someone did care about legacy, wouldn't permanent life insurance only increase their a part of their portfolio if they cared about that, because it would allow them to spend more, but then also be able to pass on just as much, if not more?
Yeah, you have to look at the tax attrition of other kinds of investments, whereas you have a true compounding effect going on with a whole life contract for over decades, a high cash value whole life contract with an increasing death benefit. So that's one piece. Yeah, we talked earlier a little bit about the inefficiencies of trying to pass assets in a qualified account. If you really look at it, a qualified account's not intended to create legacy, long-term legacies. I think you can make a pretty easy argument on that because of all the taxation that happens on the back end. So you were able to grow it, but the idea was that you deferred taxes so that you could grow a sizable nest egg. You paid taxes on the harvest, right? And that's what's going to happen. You and your not only for you, but also for your loved ones are going to pay taxes on the harvest. So this is a seamless way to create a legacy plan, and it's just going to continue to grow and compound if you really do it and you're committed to it intentionally. So,
Let's talk about the phrase life insurance has a terrible rate of return. How would you, as an attorney, respond to that?
well, it doesn't. First of all, if you really look at if you look at what you're getting on the guaranteed and then non-guaranteed side, we run numbers all the time. Let's say you're getting 6% tax free, which could be pretty conservative. I don't know how you guys run your numbers, but um, so then you know if you're paying taxes and you're in a 25% bracket or something, then that brings you up to about 8 in a market based investment. You can people argue that well you can you get 8% every year
Yeah.
in the markets? When you're
Eh,
talking average returns, you're not talking about that.
yeah,
So
and just to be clear, Steve, when you talk about 6%, what are you referencing internal rate of return of whole life insurance?
Uh, well, it's a I mean, when you get into IRRs, and then you're also getting into the death benefit piece, which is gonna be huge in the beginning. Yeah, I think with the math that we typically do, and keep in mind, I rely on people that are smarter than
Okay.
me on
Okay.
the math side.
Okay.
That's why I went
Okay.
to law school.
Yeah, yeah. You're like, yeah, I
But
would
yeah,
say, and again,
let's
this
say
is
that you're getting a 6% return every year, in terms of your return on cash value. When your
okay.
policy matures, it's not gonna be in the early years, right? But when your
Yeah.
policy matures, and that's tax free. I mean, that with dividends, um,
Yeah. Yeah.
you can argue
I would just
that. We
say,
don't try to argue that all the we're not trying to say don't invest in anything else. What we're trying to say is this is the best place for your safe capital.
yeah.
Uh, but you can make an argument that it also can be competitive when you consider the downsides of other
Yeah.
kinds of investing.
Yeah, and I'll just to be clear, if you look at history, this we're right now, if you look on a map kind of deal, like we're pretty low when it comes to interest rates, like projection. So
Right.
right now with the companies that we represent, and I know Barry and some of the companies he represents, we're the internal rate of return right now in any projection whole life might be 5.5 at the highest, but let's just say it's like 4.5. But when you factor in all those other things that we talked about, taxable equivalents, the having fees, the cost of insurance, you could easily get to an equivalent value of 8, 9%. And then you're starting to talk about like, okay, what other asset over a long period of time can do this? And oh, by the
Right.
way, what type of risk are you taking on? And so while so I wanted to just clarify that because I know that some of the comment section will definitely let
We'll
us
ask that.
know
Yeah,
what.
they right, and so the key is you can see the numbers, right? If anybody wants to comment, I mean, this is something that's demonstrated inside of a policy. You can look at
Yeah,
the IRR, and the idea is when you look at that IRR, depending on how mature the policy is, you can see that that was for every year. People get confused about that.
exactly.
So
Yeah.
you gotta think of it that way, and how that's going to square with other kinds of
It's
places
funny to
that
me when I first got into the space, people were like, "Don't ever show the IRR because it's really negative." Like, it's almost like just show the gross dividends, and I just think that's misleading. But
right,
I actually, when I started understanding how IRR worked, I'm like, guys, this is amazing. Are you telling me you get all the benefits of life insurance, you get liquidity, you get access to your money, all the things, and you're saying that it's getting a 3.5 to 5% every single year, and that we're not even factoring taxes. You factor in taxes, like, are you guys like why aren't we screaming this from the rooftops?
yeah,
It's because people s- sell it as an investment, and 5% is not sexy, and because they
yeah,
don't understand all the other benefits. So
yeah.
I'm with you. I'm with you on that. What would you say to the person that says, "Well, okay, Steve, You guys always talk about borrowing against. There's nothing unique about borrowing against. Look at Elon Musk. He's borrowing against his stocks.
Yeah,
People can put their money in the market and borrow against 75% or potentially less of their asset based line of credit, HELOCs.
right.
There's a lot of other assets. Life insurance is nothing special about borrowing against. What makes life insurance better or different when it comes to using that asset versus all the other assets that you could technically lend against?
I love the flexibility of it. I just think if you for a business owner, for somebody that wants liquidity and likes to take calculated risks with their abilities throughout their lifetime, I like that you can take a policy loan, which is immediately available. You're not applying for it. You don't have to jump
Yep.
through a bunch of red tape, and it's flexible in terms of repayment. So it would just be deducted from your death benefit, and so then you can repay it on your own terms. And I like the way that that the loans are repaid as well, going right back so that it's available once again, so that you can cycle them. I think these are the things, and there may be some other assets, setups that you're aware of, Caleb, that allow that. Um, but to me, this is the cleanest. Make a phone call and you have ready cash, and then your entire cash account continues to do what it's been doing, which is truly compounding within the policy.
Yep.
So,
Yeah, I agree. I think if the only thing you cared about, if someone came to you or me and the only thing they cared about was the cash growth and the being able to lend against, nothing really special about life insurance. In fact, there's probably other assets, potentially like gold and other things that potentially would give you a better result. Now, all those other assets have usually two things that you get with life, like you don't get in those assets that you get with life insurance. Number one is usually these assets have some type of volatility. Well, houses
right.
never crash. Well, in 2008 they did. Well, gold is super stable. Well, has gold ever gone down? Bitcoin, like, can you imagine if you lended a bunch of money off of crypto recently? Like, I'm not anti crypto. I'm just like I wouldn't use that as like the safe asset to blend against.
Yep,
The
yep,
market comes like the part of the reason like why there's so much volatility is there's so much leverage built into these, and so when the market, it's almost like you create incentives to crash the market to literally be able to like ruin people's positions to take advantage of the little fishes that are using leverage. So there's that aspect that life insurance rock solid. Okay, so you don't have that, but then you have the contract, the trust, the life insurance benefit that you don't get with those other things. So I'll be very
right.
clear. It's like mathematically, there's nothing super, super sexy about life insurance, borrowing against it. Like if that's the only thing you care about, it's like, okay, I understand.
Yeah,
I understand the talking points of like not why you wouldn't even do that. But if you understand all the benefits of life insurance from an estate standpoint, and then you're telling me you get all those benefits and I get to utilize my cash and potentially make other decisions while I'm alive, and I still get all these benefits protecting me for my future. That's, I think, where the light bulb moment, the aha moment happens, and that's what I'm hoping to be able to, get across to people. And I think that's how I would answer the what makes this different than other assets. Like, but being
yeah,
able to borrow against is nothing special. But most people are not going to let you borrow against 95% of the asset value because of volatility. And most of these assets don't have all the a whole laundry list of other benefits outside of their ability to be able to lend against.
right. It goes to what we were talking about earlier, Caleb, with just the favorite asset idea, that there's just very limited hassles, none really. So you take a loan out, you know that you're taking it out of a stable place. You can pay it back at your discretion, and it becomes better as you get older. So,
Yeah,
and this is something that I think a very sort of addictive society forgets. Like as you get older, you have more needs. You need more stability. You're not going to have less. So therefore, the
yeah,
term analogy fails, right? You don't want to be stripping away protections and things that are serving you as you get older.
yeah,
So this is something that lifelong. It's just going to improve with your age, which
yeah.
is an important piece. So,
You have this thing called the legacy life cycle. I'm wondering if you can break that down for us.
well, the this is probably something Jason did, so I have to kind of put my own interpretation to it. But to me, it kind of goes to everything that we've been talking about. This sort of wealth transfer coach idea, which is the cap here. It's kind of in beta for us, but what this is it's taking a lifelong perspective. So somebody like yourself coming in with kids, a business, to be able to look at your intentionality over a lifetime. And the life cycle can pertain to specific things. So it can pertain to your funding, your policy phase. You might have premiums drop off at some point, and and then your policy is just going to continue to grow. You've gotten all your money back, and Barry demonstrates this all the time. So there's going to become a point in that policy where you've spent X number of dollars and you have more than that in your policy. So that's probably marker one in terms of the life cycle. And then it's growing at that point. And at some point, you might be wanting tax free income for tax free retirement. That's one piece that we counsel people a lot. That's discretionary. It could be a buffer to other investments. So if you don't want to take out of your other more volatile accounts, that can be your retirement buffer. So you have those retirement years. So you have your early funding years, you have your maturity years, and then you have your retirement years. And then I think you're eventually going to have your wealth transfer years. So to me, that's the life cycle. Your increasing death benefit is being funded through your whole lifetime. And what that's going to do is eliminate a lot of problems on the back end, which is really the liquidity problems that people have. All the things that people start to think about when they're older, you could be planning in advance through a lifetime to if you had the life cycle idea embedded in your thinking. And so I talk to young people and say, just get very intentional, like with your all of your choices. Marriage obviously is a big one from the standpoint of risk. um, then you have your kids, get very intentional, and then your businesses and things, and be intentional about building wealth in the same way, and cultivating peace of mind in the process, which, like you said, it's not sexy, but it
Yeah.
isn't. I mean, true
It's
wealth building, I don't think it is. So yeah.
It's sometimes the hardest work is the things that no one wants to hear about. There's no hacks, there's no, like, 30 steps to do X, Y, and Z, but really important to dial in. Why do you believe life insurance is so misunderstood and hated?
That's a baffling one. I mean, you look at human nature, right? Other than it's sort of being fueled by, I think, very influential groups. Um, it's charged. Like if I tell you, Caleb, what the healthiest diet is, you might not agree, right? And you might say, well, I like this, and so we might go
Yeah,
back and forth. There are certain things you just don't tread on. It could be somebody's political beliefs. I don't know why this one is as charged as it is. Uh, it seems like people have been like there was a very successful PR campaign by certain groups to tell people what a terrible investment whole life is, in particular, traditionally designed whole life,
yeah,
which even traditionally designed whole life, I feel like there's a purpose for it. It's not a bad thing. I mean, you're paying for it. Where if you can put your money somewhere else, you think that it's more ideal, that's fine. But there's a legit value to the product, right? You're establishing, you're locking in life insurance. And we talk all the time about that with notable people that have used their life insurance for different things. And it's been very successful for them, Walt Disney and some of the others. So I really don't know, other than I think people get very, I think it's the fear and greed piece, and
yeah.
people get very locked in. If I can't get X percentage of return on my money, then this is a terrible idea. And they're not thinking about the other factors. They're not thinking
Yeah.
about yeah.
Yeah,
re-
I think sometimes we're in our own bubble and, like, we're talking to people that are doing things the right way. We're structuring policies. Like, I'm looking at illustrations every week that are just like I'm looking at 'em like, "These are amazing." Like, we're structuring these things really flexible and all, and then we're understanding the benefits. But most of the world that sells life insurance has 10% or less of the knowledge that you and I have been I won't even say gifted, like, blessed with. And so, like, they don't have that. They're structuring policies that are inferior, like, straight up. From a contract standpoint, like, they're not designing the contract very favorably, and they're selling it like an investment, and these insurance contracts and assets are just not going to outperform many investments from like a, especially if you have that expectation. It's like they'll almost like always under promise and over deliver. A lot of times I feel like the world is like, the insurance space is like over promising all these things. The education's not there. People get, and then they hear people and it's so easy to attack, like, oh, let's take a 12% return. It's interesting to me because you don't have to, on an illustration, you have to like, you can't just show whatever. Now on IULs, you can get creative, but on a whole life illustration, you can't just show whatever. But someone could run their mouth and say, "Oh, let's do a future value calculation of 12%. What does $500 a month?" And you look at these numbers, and they're like over time, they're like millions and millions of dollars. And then you just go like, "Hey, you got scammed." I hate that word, but you got scammed. And all they cared about was money. And like you just like all of this mess, it all piles on, and there's a lot of elements of truth to it. That's what's frustrating is like, yeah, there's aspects of this, and that's why I think we need, if we're gonna actually make insurance like have people come, like we have to be able to call out the badness that happens in our profession and industry. Um, because I feel like if we don't, we're going to lose a lot of credibility. But I think there's an opportunity to align with the same talking points that a lot of people are using, and actually get people to say, actually, yeah, when set up and used properly, just like alternative investments, just like
Yeah,
businesses, like for the
yeah.
record, most people fail in business.
That's where
Um,
I was going. As
yeah,
you're talking, I'm going, yeah, because you totally captured something that I didn't think of, which is basically other people sort of poisoning the well, so to speak, which is true. I mean, there's bad actors in every field, right? You have bad attorneys, you have bad financial advisors, you have bad insurance agents. The one thing is, I think people need to mature a little bit and be willing to not demonize something because they don't understand it.
Thank
So
you. Just because somebody or because an industry or like, yeah, just because it has been bad, like, are we just gonna be so elementary and say, "Okay, most businesses fail. If you're doing a business, you're a failure," or like, "It's bad." It's like, no, also some of the greatest wealth has been created because through business. So, do you wanna just complain about it, or do you wanna figure out the ways to actually have a successful business and not a failing business? That's kind of the same way I think about this life insurance conversation.
well, and they all are though. I lump them together though. See, maybe that's my a little bit more gray than you have, which is that this stuff everybody nobody's a saint. I mean, yes, we want to be a saint. Hopefully, we're in that mindset that we want our our integrity to really grow as we get older, right? Which I'm hopeful for personally and everybody I work with. But there's a lot of mud in the water out there. I mean, financial advisors, what I don't like is that the finger pointing seems to be kind of in one direction
Yeah.
primarily. And I've seen, I mean, you got this 1%, right? You got this fee that financial advisors are charging every single year that somebody holds a portfolio. And I interacted with a lot of people as a trust and estate attorney, and there were great people in those arenas and maybe not so great. I sometimes was wondering what some of the people that I crossed paths with actually did to earn earn that money, so every year, year after year. So I think and it could be in any arena and look what happened in 2007, 2008 with the real estate and all the chaos that ensued there, and people's lives were destroyed. I remember my clients that died from it. And so if you see that stuff and then you think about those kinds of things and then compare it to the big bad life insurance agent like Barry, who's trying to do the best he can, he's got hundreds of reviews from clients and really doing a good job and blessing a lot of people. And so then you go, okay, you just put it in perspective and move on because there's a lot.
Steve, is there anything else you want to talk about before we land the plane here?
I think that what you're doing is fantastic as a mouthpiece for doing this right, Caleb. And I think we're like minded with that in terms of our two groups. I like the and asset. I think I think your math that you're looking at doing is forward thinking, that you wanna really crunch the numbers, and so I'm interested to see what you come up with on that.
Cool. We'll have to collaborate on some of those calculations. Steve, thank you. We'll include your website, any other resources, including, if you want, your Kingdom Money, Why Conventional Wisdom Fails and What Wealthy Families Actually Do. Um, that book just came out, and I think we might have to have you back on to actually go through that. But thank you so much for what you're contributing. And I'm going to ask you offline on some other ways that we can collaborate on. So I'm very thankful for our time.
Likewise, I appreciate it. Thanks for having me on.
We've helped people unlock millions of dollars in hidden value just by reviewing their old life insurance policies. Unfortunately, thousands of people do not have life insurance policies set up properly, which could be costing them a lot of money. If you have a policy, the few minutes it takes to fill out our form could be the difference between continuing to waste money or unlocking serious value. If you qualify, we'll review your policy 100% for free and give you the honest breakdown you deserve. Click the link in the description or take comment below to apply.